Most people starting a business think that setting up a company will save them thousands in tax, and that mistake can easily cost them $3,000 in the first year alone. If you are starting a business right now, this is the single most important structural decision you'll make. Get it wrong and you'll spend the next 5 years paying for a company structure you don't need, bleeding money on compliance fees and getting zero tax benefits. I'm Krishan Sharma from KNS Accountants, and over the past decade, I have structured hundreds of businesses across Australia. Here's what I have learned. 70% of the business owners get this decision wrong in year one. Not because they are careless, but because they chase the wrong number. In this video, I'll break down the two structures available to you as a business owner, sole trader versus company. By the end, you'll know exactly what structure makes sense for your situation, when to switch, and the one licensing trap that could cost you 12 months of downtime and $30,000 if you get the timing wrong. Let's get started with the sole trader structure, because this is the one most people either completely ignore or run past to get to a company. And that's a mistake, because it's the most simple and often all that's needed. In this structure, it's just you with an ABN attached to your tax file number. When you earn money, it's your money. When you pay tax, it's based on your personal tax rates. Setting up is easy too. You can register an ABN online and you are done. At tax time, you lodge one return with a business schedule attached. No separate company tax return. No financial statement, just your personal tax return with your business income and expenses included. But the big thing to understand is there is no separation between you and your business. If something goes wrong, like if you get sued or you racked up debt, it all comes back to you personally, your house, your car, your saving, everything's on the line. Then there's the company structure. A company is a separate legal entity and it is own things in the eyes of the law. It has its own tax file number, bank account, and yes, its own tax obligations. Here's where most people trip up. They hear 25% tax rate and think that's the end of the story. But the reality is that 25% is just what the company pays. When you want to use that money personally, you need to extract it through one of the three ways: salary, wages, dividends, or loans. And each of these has tax implications. If you pay yourself a salary, you are taxed like any employee at your personal marginal rate. If you take dividends, you are still paying tax on them at your personal rate, though you get a credit for the tax the company already paid. And if you take a loan, you'll need to deal with Division 7A, which is often compliance nightmare involving loan agreements, interest rates, and structured repayments. The other thing people miss is that while a company offers some legal separation, you are not completely protected. As a director, certain liability still comes back to you personally, especially things like unpaid superannuation and directors' penalty notices from ATO. Okay, let's talk actual numbers, because this is where it matters. Say your business makes 180,000 profit. As a sole trader, that entire 180,000 is added to your personal income and taxed at your marginal rate. If you are in the 37% bracket, you are paying serious tax. As a company, that 180,000 is taxed at 25%, so the company pays 45,000 in tax, leaving 135,000 in the company. Sounds great, right? But here's the catch. If you need to live on $80,000 a year, you need to extract that from the company. You could pay yourself a salary of $80,000, which means you pay personal tax on that $80,000 just like a sole trader would. Or you could take it as a dividend the following year, where you paid tax on it minus the franking credit. The tax advantage only really kicks in if you can afford to leave money in the company. If you are making $180,000 but you only need $80,000 to live on, you could leave $100,000 in the company, tax at 25% rather than having it all taxed at your personal rate. But if you are making $100,000 and you need every dollar of it to live, a company structure might actually cost you more once you factor in setup cost, annual ASIC fees, and accountancy fees. So, what kind of setup expense do you need to keep in mind? Well, sole trader setup costs minimal. You register an ABN for free and you are good to go. If your turnover hits over 75,000, you need to register for GST, but that's still straightforward. On the other hand, company setup costs around 1,500 to 2,500 depending on your accountant. Then there are ongoing costs like annual ASIC fees, a separate tax return, financial statements, and potentially high accounting fees. So you are looking at minimum $2,000 to $3,000 per year in compliance costs. But like everything else in business and finances, there are risks attached to both structures. And this is often where sole traders get exposed. Let's say you are a trainee working on construction site, which means there are a physical risk involved in what you do. Being a sole trader means you need to arrange your own insurance, and if something goes wrong, you are personally on the hook. Whereas with a company structure, you get workers' compensation coverage if you pay yourself a wage. This is huge if you work in a high-risk industry. But here's something most people don't realize. Many larger contractors don't even work with sole traders anymore. If you are a trainee trying to get contracts with builders, they often require you to have a company structure because they don't want the compliance headaches of determining whether you are a contractor or an employee for superannuation and workers' compensation purpose. So, if you are starting a business now, what structure should you start with? I always recommend clients start with a sole trader proprietorship if they are testing a business idea, are a one-person operation, are under $100,000, and are in high-risk industry. The beauty of starting as a sole trader is you can switch to a company later when it makes sense. And most successful business starts this way. Thanks to low cost and simple compliance, and you can focus on building your business rather than managing corporate structures. And here's a handy tip. Don't register for GST until you hit 75,000 in turnover. There's no benefit to dealing with GST compliance if you don't have to. But how do you know when it's right time to switch to a company structure? Well, the tipping point usually comes when one or more of these things happen. Number one, you are earning consistently over 150,000 and have money left over after living expenses. This is where the tax benefit actually materializes. If you can afford to retain profits in the company, the 25% tax rate versus your personal 37% or 45% rate makes a real difference. Number two, you are hiring staff. Companies provide better structure for employees, clearer liability protection, and a more professional appearance to clients. Number three, you are getting bigger contracts. As I mentioned before, many larger business and government contracts require you to operate as a company. Number four, you are in a high-risk industry. Asset protection becomes more important as your business grows and you have more to lose. Number five, you need to raise capital. Companies can issue shares to investors while sole traders can't. Now here's something that often catches people out. Some licenses are tied to your business structure and can't be transferred. NDIS registration is a classic example. If you start as a sole trader with NDIS registration and later switch to a company, you can't just transfer that license. You need to reapply as a new entity, and the NDIS registration process can take 12 months and cost you $20,000 to $30,000. Construction license usually transfer more easily, but it varies by industry and state. This is why sitting down with an accountant before you start is crucial. Sometimes it makes sense to cope the higher cost of the company from day one if switching later will cost you a year of downtime and tens of thousands in licensing fees. Finally, one thing people ask about is whether you can go from a company structure back to sole trader. The answer is yes. Though it's not something most people do, it typically happens when someone's winding down towards retirement, has lost the big contract and needs to scale back, or realizes the annual compliance costs aren't justified by their income anymore. You'll face some tax implication and restructuring costs, but it's absolutely doable if your situation changes. Now here's a little known caveat you'll need to keep in mind when setting up your business. If you are a consultant, contractor, professional whose income exceeds 80% of your own personal skills and efforts, the ITO might classify your income as personal service income, PSI. When this happens, most of the tax benefit of the company structure disappear. You will still pay tax at personal rates even though you are operating through a company. PSI rules are complex, but the basic test is whether you could easily substitute yourself with another person doing the same work. If your client is really buying your skills, specifically, you are probably going to get caught out by PSI rules. So here's the bottom line. Most people starting out should start as a sole trader. It's cheaper, simpler, and lets you focus on building revenue rather than managing corporate compliance. Switch to a only company when the number generally justify it, when you need structure for bigger contracts or employees, when your risk profile changes or licensing requirement demands it. The biggest mistake isn't choosing the wrong structure. It's deciding without understanding your actual situation. This is exactly where speaking to an accountant makes all the difference. At KNS, we run a detailed analysis for every client before they commit to a structure. We look at the industry, your income projection, your contractor requirements, and the most importantly, your licensing obligation. If you are trying to figure out which structure makes sense for your business right now, book a consultation with us. You can find the link in the description below. And if you found this helpful, make sure to check out our other videos and subscribe to our channel. See you in the next one.